What if I tell you there is a semiconductor stock that has already handed investors gains of over 2,700% in a single year? And the most explosive part of the move might still be ahead. Let that sink in for a second. While most investors were sitting on the sidelines, debating whether the AI boom was already over, whether valuations had gone too far, whether the smart money had already cashed out, one company was quietly becoming the gatekeeper of the entire artificial intelligence revolution. Welcome back to Smart Stock Sam, the channel where we cut through the noise and give you the real trade. Today we are doing a comprehensive revised breakdown on SanDisk, ticker SNDK. We are answering the question everybody is asking right now. Is this stock still a buy after such a massive run? We are going to walk through where the revised price targets now stand, what the institutional money is actually doing under the hood, and the single mechanical catalyst arriving in just days that could send this thing vertical whether Wall Street is positioned for it or not. Stick around, because by the end of this video, you are going to understand exactly why some of the most sophisticated money managers on Earth are still aggressively loading up, even at these levels. Now, as of today, April 14th, 2026, SanDisk is trading at $952.50 per share. Just yesterday, a single Monday session, it surged nearly 12%. That is not a data error. That is not a fat finger glitch on a chart. That is the professional institutional market finally realizing they are dangerously underweight on the one commodity the AI world physically cannot survive without. And the three forces driving this convergence are unlike anything we have seen since the early days of the internet boom. We are talking about a structural supply shortage that has no quick fix, a $600 billion tsunami of mandatory institutional buying that is days away, and a derivative coil so tightly wound that the trigger is already being squeezed. Let us walk through every single layer so you understand exactly what you are dealing with. To understand this trade from the ground up, you first need to understand what is actually running out. NAND flash memory, the storage technology inside every data center, every large language model training cluster, every enterprise server rack in the world, is in a full-blown structural shortage. This is not a temporary blip or a supply chain hiccup. Analysts are projecting this shortage lasts all the way through 2028. Now think about what that dynamic actually means in a boardroom. The hyperscale customers, the Googles, the Metas, the Amazons of the world, are not sitting across a negotiating table trying to squeeze vendors for a lower price per unit. They are calling up SanDisk and saying, "Give us everything you have and tell us what it costs." Priority of supply has completely replaced price negotiation. SanDisk proved this power in the most direct way possible on April 1st, when it implemented a 10% price hike across its enterprise lineup. You know what happened? The biggest buyers in the world nodded, accepted the new pricing, and asked when they could get more. That is a level of pricing power most publicly traded companies would do almost anything to have. And that pricing power is showing up in hard financial results. In fiscal quarter 2 of 2026, SanDisk pulled in over $3 billion in revenue. That is a 61% increase year over year, not a modest beat, not a slight outperformance, an absolute blowout. But the number that should genuinely make your jaw drop is the data center segment performance, which posted a 64% sequential surge from the prior quarter. That is not a year-over-year comparison. That is quarter-over-quarter growth of 64%. That is pure AI enterprise SSD demand showing up as real dollars on a real balance sheet. And there is no indication the pace is slowing. With 82% institutional ownership, the investor base holding this stock is not made up of retail traders who panic sell on a red Wednesday morning. These are the largest sovereign wealth funds, pension managers, and hedge funds on the planet. They are not here for a quick flip. They are building generational positions because they believe in a multi-year thesis. And SanDisk is not sitting idle on the cash flow either. They are building a moat so wide that competing with them in this space will become structurally impossible for a challenger. They just committed $1 billion into Nanya technology to lock in long-term DRAM supply. Why? Because dominating AI-focused storage at the highest level requires a fully integrated, diversified hardware portfolio, not just NAND. They also extended their joint venture at the Yokkaichi manufacturing plant all the way through 2034. That is a 10-year production guarantee on state-of-the-art, three-dimensional flash memory. Let me be very clear about what that means. They are not just winning the trade today. They are engineering their dominance across the entire next decade of the artificial intelligence supercycle. That is the kind of strategic clarity that institutional allocators get paid to identify and then hold through volatility. Now here is where things get truly explosive, and this is the part of the video I need you to pay very close attention to. There is a catalyst arriving on April 20th that has absolutely nothing to do with memory chip pricing, earnings beats, or product launches. On that date, SanDisk officially replaces Atlassian in the Nasdaq 100 index. Now, here is why that date should be circled on every serious investor's calendar. There are over 200 distinct investment products that track the Nasdaq 100, exchange-traded funds, index mutual funds, structured products, and derivatives. Together, they manage over $600 billion in assets. When SanDisk is formally added to that index, every single one of those products is legally and contractually mandated to hold SanDisk in proportion to its index weight. They are not making an investment decision. They are not conducting a valuation analysis. They are executing a mechanical requirement. It is price agnostic, time-stamped, mandatory buying. The market is already front-running this right now. Any institutional desk that is underweight is in a race to establish position before that flow wall arrives on the 20th. The price action we have seen this week is in large part that scramble happening in real time. So how high are the professionals actually targeting this thing? Wall Street is quite literally playing a game of catch-up with revised price targets arriving faster than most analysts can update their models. Citigroup has set a target of $980. Jefferies and Mizuho are both anchored at the $1,000 mark, treating that level as the next major psychological destination. Evercore ISI just stepped out with a bold $1,200 target. And then there is Bernstein, whose base case sits at $1,250, with a blue sky scenario of $3,000 per share, built on a projected 2027 earnings per share of $224 at peak cycle multiples. Now, does $3,000 sound like a fantasy today? Remember, this stock was a fraction of its current price just 12 months ago. Now let us dig into the technical mechanics, because this is where the trade setup becomes genuinely electric. There are nearly 14,000 open option contracts sitting precisely at the $1,000 strike price. In trader language, this is called a call wall. Here is the critical mechanic you need to understand. As the price climbs toward $1,000, the market makers who originally sold those call options are forced to purchase the underlying stock to hedge their exposure. This process is known as delta hedging. The higher the stock price rises, the greater their hedge requirement becomes, which means they must buy more stock, which pushes the price higher, which increases the hedge requirement further still. It is a mechanical, self-reinforcing loop. Breaking above $1,000 would not just be a milestone. It could ignite a vertical squeeze through pure derivative flow mechanics that has nothing to do with any new fundamental development. The pressure inside this coil is being amplified further by the short interest picture. There are currently over 8 million shares held short against this stock. The days to cover ratio stands at just 0.56, meaning at average daily trading volume, short sellers could theoretically cover in less than a single session, but in practice, any coordinated exit attempt would spike the price violently against them before they finished. If the index inclusion flows arrive simultaneously with a short squeeze trigger, you are looking at a scenario where involuntary mechanical buying from multiple distinct sources hits a stock with limited available float at exactly the same moment. Could that scenario fizzle out and go nowhere? Technically, yes, but that would mean $600 billion of mandatory passive demand failing to move a stock with a tight float. and that is a bet most professionals are simply not willing to make. Here are your actionable levels for the current week. The entry zone is $925 to $940, aligned with psychological support and the 5-day moving average. Immediate support sits at $900, and the structural floor backed by massive options open interest is $800. That is your hard risk line, the level where the entire thesis requires a complete reassessment if broken. On the upside, $980 is the first target aligned with the Citi price call. Clear $1,000 cleanly, and the gamma squeeze mechanics engage, with $1,025 as the next logical destination and the full blue sky scenario opening wide beyond that. For options traders, implied volatility sitting at 112% means buying straight calls is brutally expensive. You are paying a massive volatility premium that can erode your position even when you are right on direction. The cleaner structure here is a bull call spread, buying the $950 calls while simultaneously selling the $1,000 calls for May or June expiration. This approach eliminates the volatility tax, defines your maximum risk from the moment you enter, and places you squarely in the pocket of the derivative mechanics we just outlined. You cap the upside, but you also fully protect your downside in a way that straight call buying simply cannot do at these implied volatility levels. One technical note worth acknowledging honestly, the RSI reading currently sits at 84.13. That is deeply overbought territory by any conventional measure, and a cooling period or sharp short-term pullback is not just possible, it is mathematically probable given the sheer velocity of this run. However, a confirmed golden cross has just printed on the chart, signaling that the long-term structural trend is intact and accelerating. In a market driven by mandatory passive inflows at this scale, traditional overbought readings simply do not carry the same mean reversion weight they normally would. The path of least resistance remains upward. The $800 floor is your guardrail. Respect that line, and the trade remains fully intact. Before the final verdict, an important disclosure. Nothing in this video constitutes financial advice of any kind. I am not a licensed financial advisor, broker, dealer, or investment professional. Everything shared here is strictly for educational and informational purposes only. The stock market involves substantial risk, including the possibility of losing your entire invested capital. Past performance, no matter how dramatic it appears, does not guarantee future results. Volatility cuts in both directions with equal force. Always conduct your own thorough research and consult with a qualified financial professional before placing any trade or making any investment decision. High implied volatility environments, like the one surrounding SanDisk right now, carry elevated risk of rapid, significant losses, even when the directional thesis is correct. So here is the final verdict on the most explosive stock of 2026. SanDisk earns a definitive strong buy at this moment in time. The company sits at the precise intersection of a generational AI storage supercycle, a predictable and imminent liquidity event of historic scale, and a technical and derivative setup wound tighter than almost anything else in the current market. Yes, the RSI is screaming caution. Yes, a breather is possible at any moment. But in a market where $600 billion of mandatory buying is about to hit a structurally supply-constrained stock with 82% institutional ownership and a 14,000 contract gamma trigger sitting right at $1,000, the weight of evidence points overwhelmingly in one direction. Accumulate near support, respect the $800 risk floor, and let the mechanics do the heavy lifting. Now here is the question I genuinely want your take on, and I want you to leave a real answer, not just a number. If mandatory index inclusion mechanics represent hundreds of billions in forced passive demand arriving at a fixed date, does that kind of structural buying permanently reset how we should think about valuation ceilings for a stock? Or does the market always find a way to correct for mechanical distortions once the forced buying window closes? Leave your view in the comments. I read every single one, and some of your responses genuinely change how I analyze these setups. If this breakdown gave you something valuable today, hit the like button right now. It takes 2 seconds. It is the single biggest signal that tells the algorithm this content deserves to reach more investors. And if you like my analysis, for which I put a lot of hard work every single day, do not forget to show your support through Super Thanks. Subscribe to Smart Stock Sam if you have not already joined the community. We are tracking every development on this trade in real time as April 20th approaches. The AI supercycle is not cooling down, the storage shortage is not going away, and the next leg up may already be loading. I will see you in the next one.